and welcome to today's session. Myself Anil Diwan, a financial professional with over 2 decades of experience in banking, NBFC and structured trade finance solutions. Today, I want to talk about a very crucial but often under discussed area of business financing, funding, bill discounting in both domestic and international transactions. Now, let's start with the basics. What is a bill discounting? In a simple terms, it is a way for business to unlock the working capital tied up in their receivables. When the seller raises an invoices or a bill of exchange on the buyer, instead of waiting for 60 days or 90 days for payment, the seller can approach a financial institution to discount that bill. The lender pays the seller upfront, of course, after deducting a small discounting charge. They charge for that and then collect the amount from the buyer at maturity. This instrument is a lifeline for a cash flow management for a business, particularly in industries where the credit cycles are too long. In domestic trade, bill discounting helps suppliers and manufacturers maintain smooth operations without crunch of funds. For example, a mid-sized manufacturing company supplying goods to a large corporate may not be able to wait for 3 months for payment. By discounting the bill with a bank or NBFC, they immediately receive liquidity to fund raw material, salary, or further expansion. Here, funding largely depends on the buyer's creditability. Financial institutions are more confident when the bills are backed by reputed corporates with strong rating. When we talk about the exporter, things get even more interesting. Exporters often faces long credit periods, currency risk, and cross-border collection challenges. There are many challenges in the collections. Export bill discounting, also known as the export factoring, helps mitigate these issues. The exporter submits the export bill drawn on the overseas buyer. The financial institution, sometime in coordination with the correspondent bank abroad, provides immediate funding. And later on, once the overseas buyers remit the payment, the transaction is settled. Now, one major advantage is that this is only helps exporters to manage the foreign exchange risk by locking in values early. Moreover, when the backed by letter of credit or confirmed purchase order, bill discounting become an even safer proposition for financiers. Now, question is, why is funding important? That is bill discounting. Now, in today's competitive environment, liquidity is everything. You are a king if you have a liquidity in the business. Bill discounting ensures that the business, whether they are small traders in India or large exporters shipping globally, do not face working capital crunches. Instead of borrowing heavily through term loans, they leverage their receivables to access the short-term need-based finance. Who benefits from the bill discounting is an important point to be noted. The first one is the SMEs struggling with the delayed payment. The second is exporter competing in the international market with long credit terms. And third, the large corporates who want to optimize the balance sheet by ensuring their vendors are financially stable. Globally, bill discounting is becoming faster, more transparent, and accessible. Integration with the blockchain and AI driven risk assessment is likely to reshape how both domestic and international trade receivables are financed. So, whether you are a manufacturer supplying within India or an exporter catering to countries outside India, remember your receivables are not just pending payments, they are hidden assets, current assets. Bill discounting help you unlock them. Keep your working capital cycle healthy and grow without unnecessary financial stress. That's all for today's session. Myself Anil Diwan, and I hope this insight into funding bill discounting has added value to your financial toolkit. Stay tuned for more episodes where we decode complex financial instruments into a practical business solution. Thank you.